Very good, thank you. All right, I'll get my little wand of power here. How's everybody doing? Wait till I'm done. No. So I appreciate the invitation to visit with you guys today. I'm going to talk about an issue or a topic that I usually don't get a chance to visit about. Earlier in my career, I did spend quite a bit of time in the farm management area, working with ag finance and financial management issues. Part of my job with Extension is to help coordinate and host an agricultural lenders conference every year. So this is educational updates for the ag lending community. So we built a really good rapport and relationship with the folks in ag lending. And so one of the things that I've been getting some questions about and some anxiety and some concerns about is, of course, given the lower commodity prices, what does all this mean for the financial part? What does that mean for farm financial management? What does that mean for my ability to be able to finance my operation and grow it? So I'm going to try and address that question. Again, I've got a few things. I'm going to try and introduce some ideas and some concepts, some things I want to talk about. The most important part of this is your questions. So please be sure that as I'm going through to write those down or send those in, and we'll try and get them answered. So interesting enough, I spend today a lot of my time talking about grain marketing. This is a chart of the Chicago futures market going back to 1990. Interesting thing to me, this summer when we had much lower grain prices than we do today, I got way more questions from ag lenders about, boy, where is this market going to bottom out? How bad is this going to be? Versus farm managers. And I kept thinking, man, why are all the ag lenders? I mean, it's like 2 to 1. I get one call from a farmer saying, hey, I got some corn left or I got some wheat left. And I get 2 or 3 calls from a banker saying, man, how long is this going to last? And so the fundamental question they were asking, and this ties into the theme of my talk, is, okay, we know prices are coming down. The big question the ag lenders were asking is, how long is this going to last? Is this a price drop where it's with a pretty quick recovery? Or are we going to have a price drop and we're going to stay here for a while? How long will these lower prices last? So if you look at this chart, we've got examples of a few of those different time periods. We've got it from like 2015 through about 2020. Prices came down. We're in a very, very tight range, right? And then we had another time period going into 2020 where we had a big spike up. We had a pretty rapid drop down with a quick rebound. So my question to you, why did that happen? What was the difference? And a lot of it is fundamentals. It's supply and demand. If I go back and forth between these two slides, if the focus on the blue bars, that's the inventory we had. So if the bins are full, we got big inventory, we tend to have low prices, pretty stable prices. So the question people were asking me is, well, are we going to come down and stay down, or are we going to be, is this going to be a spike? And the answer really relies on what's happening to our inventories, our production versus consumption. So you can see, let me flip-flop back and forth, you can see a general pattern. Okay, when the blue bars are really big, we tend to have low prices and pretty stable prices, and vice versa. When we have very tight supplies, we tend to have very high prices with a lot of volatility. Moving on to soybeans, we see the same basic patterns, right? We've got some time periods where we have drops with a quick rebound, kind of a V shape, and we got time periods where it comes down and just stays there for a while. Okay, I also want to point out and remind everybody, we have the same basic pattern with inventories. Now, because of all the issues going on in the marketplace today, especially with global trade, I need to remind everybody of what happened. So see on the right-hand side where those blue bars get really big, 2018 and 2019. Okay, guys, what happened? Why did we get these huge carryover stocks and reserves of soybeans? Tariffs. Trade war number 1. That was our trade war with China. So how do we take those inventories down so rapidly? A lot of people are saying, man, this is going to take years to work through this inventory. We're going to have low prices for a long time, but that didn't happen. Why? 2 things happened. Okay, notice the green line that has kind of a V to it. That is production. We had a big cutback in planted acreage. We had kind of averaged the below average yields, so we cut our supply quite a bit. And then we had that phase one agreement. Remember the phase one agreement right after the trade war? China came in and promised they were going to buy a bunch of U.S. ag products. Now, they didn't quite live up to the expectations, but they came very close. They bought a lot of corn. They bought a lot of soybeans. I mean, they were able to pull the inventories down really fast. Okay, so where I circled this chart here, that's during that trade war. And what happened during phase one and the fact that we cut acreage, we had a very quick rebound. So as an ag lender, one more thing I just point out, this is spring wheat. We have the same similar pattern. Okay, so the problem we have with lending is all of these ag commodities tend to kind of go up and down together. They're not perfectly. They have their own little dynamics. They have their own little ways of moving separately from each other. But in a big picture sense, from year to year to year, when corn prices are high, bean prices are high, wheat prices are high, and vice versa. And you guys as farm managers know this. I'm just reminding you of things that you've thought about and talked about before. So why do the ag lenders get so concerned about this question, how long are we going to have low prices? Just want to make you think. You don't have to holler anything out. Just want to make you think. Because it influences term debt. You've got your operating notes, right? Every year you borrow some money to be able to put the crop in, paying fertilizer and chemical and seed, etc. But you always have term notes. So what happens now if we start to have some losses? What happens if you have a year or possibly two where all of a sudden you have some losses on the farm? How do you finance that? Typically, you take that loss, take the short-term like operating loan, or whatever you can't repay, and you turn that into and bundle it into what's called term debt. You take that and roll it into some existing debt, and you start stretching those payments out so you can make the cash flow. And every lender always has in their portfolio, in all the farm managers that they work with, they always have a few that are kind of up against the edge financially. Okay, and now as we go into 2025 and things get really, really tight and cash flows and budgets get to be really hard to pencil out, the ag lenders have to sit down and say, okay, where do we draw the line? Who are we going to do business with? Who are we going to try and work with? And who do we say, no, I'm sorry, we can't do this anymore? Now, I want to be very clear. I'm not going to pick on ag lenders. I'm not going to stand up here and bash the ag lending industry. I'm not. What I'm going to try and do is explain some of the challenges they're facing and why they have to make the decisions they do. Okay? And your thinking as a farm manager is going to be a little bit different than the way the ag lender is looking at it. So this is from the North Dakota Farm Business Management Record System. And this goes back from about 2023, which is the most recent data we have, back to 2012, just to give you some time series here, some history, some reference points. Now, we don't have the 2024 data yet because you guys haven't finished all of your accounting work yet, right? We have to close out 24, send all the stuff into NDSU, we'll process it all, and we'll come up with the 24 numbers. So we're getting some of that dribbling in right now, but we don't have enough to be able to put together final official numbers. So this is from 2023. And the reason I put this in is because I wanted to show the distribution, the range of profitability in the farm industry. A lot of people think, well, I'm in a little better shape than my neighbor, I'm a little worse off than my neighbor. But I don't think you really realize the range of financial condition and profitability we have within agriculture. It's much wider and broader than most people realize. Okay? So let me just explain this very quickly and then I'll move on. So the red line, so what we've done is we've taken the farms and the profitability and divided them into three different buckets. Okay? We took the lowest 20%, the highest 20%, and then the middle 60%. Okay? So that blue line that runs through is just the mathematical average of everybody. The red line, the red bar, is what's the average profitability for the lowest profit farms, the low 20%. The green is the average earnings for the top 20%, and in that yellow is the middle 60%. So the last couple of years, especially when we look at 21 and 22, we had some really good profitable years. Even if you had like horrible crop production, if you had a drought or bad production, you had hailstorm, whatever, and you ended up in that bottom 20% for whatever reason, it still wasn't huge losses because we had big profits. Prices were really high. And the ones that were making money were making a lot of money. Okay, but we use that oftentimes as farm manager, we use that as our reference point. The good days, right? You remember those really well. So what's typical? Let's think about what's typical versus what's abnormal. When you look at that graphic, what do you see as typical earnings, the typical distribution? There's always some people that have some losses and problems. You always have some people that are making money even during the toughest times. And you got everybody in the middle. So we've got to be really careful about not lumping everybody into the average, but we have to also think about kind of the distribution or extremes. I also want to point out, because we do have some support systems, some safety nets, I also remind you and caution you about what I'm going to term like ad hoc financial support or ad hoc federal assistance. So this is a graph. This was put together by FarmDoc, which is the research guys and extension guys out of the University of Illinois. They did a big analysis of this, and they printed the results. It's actually really good information if you follow them. I know the lines are going to be a little tough. I captured this from their report. I wasn't able to manipulate it. I would have made it thicker. But this is federal farm support that does not include ARC and PLC and does not include crop insurance. So these are the ad hoc programs. These are the ones that are like special emergency things that come up. And please notice, what did we see in 2019, 2020, and 21, and even into 22? Some pretty big numbers. Part of the revenue that I just showed you from the last couple of years, it's not only because of high prices, but it's because of these additional farm support payments. How long do you think those will last? Can you put that down on your financial statement? Can you put that down on your crop, on your whole farm plan to say, hey, I can cash flow this year because? The lenders will put it on as income, but only if it's guaranteed, and I'll talk about that in just a minute. So moving forward in time, we're looking at history now. Moving forward in time, what does this look like? What are some of the challenges we might be facing? What I'm trying to get you to think about today, we're in a position, we have very strong balance sheets. We're coming off some really good profitable years. The issue is, how do we prepare ourselves if we go into a time period where we have lower earnings for multiple years? This is not one of those V things with a rebound, but we get to that point, we need to be here for a few years. We have to be looking very seriously about how do we adjust and adapt to lower commodity prices. I'm not saying that's going to happen. I'm not clairvoyant. I can't forecast the future and predict exactly what's going to happen, but I do want you to be prepared for that, because you're going to have some decisions coming up now in the next several months to try and position yourself and be at the right place at the right time. Okay. We just came out with the NDSU crop budgets. This is a real quick summary of those budgets. I picked corn and soybeans as well as spring wheat from the north central region. NC is just north central. So that would be kind of that Jamestown, Carrington, Cooperstown area. I use that as kind of a reference point, kind of an average for the state. So I know your numbers are going to be different than this. Don't worry about that. I just want to go through some changes. Okay, so what are some of the things as we get into these tighter financial conditions, and in particular on the cost side, what are some changes you can make? How do you adapt to thinner profitability? You know, everybody comes to me and said, well, gee, you know, if you just come up with some better prices, it would fix all my problems. Well, that's an easy thing to do, but I'm sorry I don't have that power. Okay, so if we look at average yields, and I'm going to come down to some really important things now. So this is the market yield that would be an average for the region, corn, soybeans, and spring wheat. The market prices that are in these budgets are my forecasts for average prices for the marketing year. So I'll take blame for those. But let's look at the cost structure. I started with these variable costs, so this out-of-pocket costs, your operating costs, right? This is what goes into your operating loan. So how much flexibility, if you really had to start shaving some of your seed costs, how much could you really save on seed costs without damaging or jeopardizing yield and yield potential? Not a much. And you can nibble, okay? What about what I call crop protection chemicals, like insecticides, herbicides, fungicides? Are herbicide costs going down? You might be able to use some generics once in a while, but you guys are mostly all doing that anyway when you can get by with it. How much can you really save in costs? I mean, if you've got a fusarium problem, if you've got a head blight problem or scab problem, you better get out and spray or your wheat yields are going to really suffer. Everybody knows that. What about fertilizer? I'm going to pick a lot on fertilizer because for both corn and wheat, that's the number one operating expense. Can you save a lot of money on fertilizer nowadays? Pretty tough. So let's talk about fertilizer prices just really quick. I'm not forecasting fertilizer prices here, but I do want to give you an idea. This is urea prices. I got this from DTN. So that little gray dashed line is the 5-year average for urea prices. This is national. The red is where we are today. Yes, it's starting to tick up a little bit, but that's seasonally. We normally see this time of year. And I won't ask a question, but how many of you guys have booked fertilizer yet? When I talk to a lot of the agronomy guys, agronomy centers, there hasn't been a lot of fertilizer sales. You guys are starting to come in and talk about it now because you're waiting saying, oh man, I don't know what I'm going to plant. And prices go down? When you look at the global supply and demand for fertilizer, it's not going to go down. Guys, the fertilizer market today is a global market. If you don't want to pay the price for urea, it will go someplace else. 5 years ago, 10 years ago, this was really a local market, a U.S. market. If corn prices went down, fertilizer prices came down. Today, that's not happening because the fertilizer market is a global market. Okay? Looking at DAP, the phosphates. Where are we today versus where we were last year? Look at the dashed line, which is the 5-year average. You think we're going to have a real big drop in DAP prices? Diammonium phosphate? Probably not. Okay, let's look at, how about potash? Red line is potash prices. Now, I know we don't use a lot of potash because of our soils we have in North Dakota, but there's some that's used. What about potash? Are they going to go down any further? Probably not. Oh, and a sidebar, when we talk about trade and trade policy, where does most of our potash come from? Canada. So when we think about trade and trade tariffs and all that kind of stuff, it's not just the value of the crops, it's also the value of the inputs, the cost of the inputs. Okay, so can you save a bunch of money in the fertilizer sector? Probably not. You can nibble, there might be some savings here and there, but you're nibbling around the edges. Okay, what about next one, crop insurance? Crop insurance premium is going to go down? Well, we're right now in price discovery, right? February 1 is when price discovery starts. Well, if your insurance prices go down, it's probably because your coverage went down. That doesn't help. Fuel and lube? Can you save a bunch of money on buying cheap gasoline or cheap diesel fuel? Good luck with that. Repairs? Pretty tough to save a lot of money on repairs. Drying? Now, drying is really for corn. And we'll have to see what propane and natural gas prices do. But if you've got to dry them, you got to dry it. Okay, and then you got miscellaneous. And then you got some operating interest. To my opinion, I don't see interest rates dropping a lot. And it's a relatively small number compared to everything else anyway. Okay, so let's move over to the overheads. Your machinery costs, your land costs. So here's our core problem in production ag. When prices go up really fast, it takes a while for costs to follow, but they eventually catch up, right? So usually prices go up, costs come up, and all of a sudden prices tip and go down. How long does it take for our cost structure to adjust? It takes a while, right? And right now, we're kind of in that tipping point. Revenues are starting to drop. It's going to take a while for these costs to start dropping. So how do we save some money on our overheads? How do we try and slowly over time bring those costs down? We can't do this fast. We can't do this fast. It takes a while. So how do you bring your machinery costs down? You don't buy new. New machinery never goes down. I'm not saying you should cheat on repairs. I'm not saying you should cheat on machinery. You need machinery. This is part of your cost. If you don't have the good equipment, you're not going to be able to farm. I get that. So how do you bring that down? The simplest way, the most painless way to do this is you grind it out. You let inflation help you. What do I mean by that? And I'm not talking about financial inflation. What I'm talking about is inflation in yields. Over time, we bank on and count on trend line yields continuing. And what I'm going to spend a lot of time towards the bottom of this in just a couple minutes is saying, yes, understanding the cost per acre is important, because that's what you usually do, and that's the way the bankers like to look at it. You usually think about what's my cost per acre, what's my revenue per acre. But I also want you to think about what's your cost per bushel. So think about this. If you can keep land costs, land values or rents, flat, and you can keep your machinery costs relatively stable, what happens to your cost per bushel if we rely on growth rate in bushels? Does that make sense? And as I've looked back in time, as I've tried to study how do farmers adjust to tight margins, how do we try and bring our costs down to be more competitive globally, that's the simplest and easiest way. We've got hard ways to do this, and it's called deflation, right? All of a sudden we have a drop in land values. We have a dramatic drop in machinery values. We've already seen used equipment come down. Now, that's a good thing if you're looking for more used equipment. If you've got older equipment, you're trying to trade up and get used equipment, now's a good time to buy. We've already seen used equipment come down substantially. Now, if you bought some newer equipment or you have equipment on your balance sheet right now and those values are dropping, that's not so much fun. Because what's the collateral value? What's the estimated market value for this machinery as the values start to slip for used equipment? You see where I'm going with this? There's a lot of moving parts to understanding what's happening in the financial community. How is the banker looking at your financial condition? Okay? So let's keep going. So machinery is really tough. It's really tough to adjust land values, whether it be land value and you own it, whether it be land rent. The value I have up here for land charge is a proxy. We're using land rent as a proxy. And everybody's looking at this saying, well, geez, I pay more than that. Yeah, you probably do. But I'll also guarantee you probably have higher yields. Now, what's interesting to me is let's drop down towards the bottom. So if we look at all listed costs, and we got a return to labor and management. I didn't quite have enough space. I wanted to make this big enough. So that's return to labor and management. So you pay all of your bills, and you pay for all of your machinery and land and everything, and you say, okay, what's left over for me? How much do I earn as the farm operator for my own labor and my own management? Now notice we don't have hired labor in this because everybody has a little different conditions. I understand that. Okay, so we got a small positive for corn, we got a small positive for soybeans, we got a small negative for spring wheat. Now, if I start juggling this around a little bit by tweaking the yields and tweaking the prices a little bit, I can make those things look better. And that's one of the things that starts happening when you go into the lender, saying, okay, well, this is the averages, but maybe, we round up a little here, we round down a little here. We can massage this a little bit to come out with something that's still defensible, but looks a little better. Now, when I talk to ag lenders, they really don't like doing that. I mean, they're willing to massage it a little bit, but, to really out and out lie on that and cheat on the numbers, no, they're not going to do that. They're not going to do that. Okay? So let's talk about cost per bushel, and I want to look at the highlighted blue number. Now I'm going to pull out my cheat sheet because I had to look this stuff up. Interesting enough, so our break even, so what I'm doing here, the blue line at 381 for corn, 858 for soybeans, and 654 for spring wheat, that's your break even. If you pay all of those costs that I have listed here, and you get that for a price, you're working for free. You made nothing. That's fun, isn't it? Now, let's add a return for your labor and management. I'm going to put in $50, and the reason I pick $50 is if I put $50 per acre and add that into my cost per bushel, then I can compare it to the costs per bushel in Iowa and Illinois. So let's make that comparison. Bear with me for just a minute. Okay, so if I add $50 an acre for your risk, your time, your labor, your management, you can do the math to say, is that enough income for me? Okay, now all of a sudden my break even, if I pay myself $50, is $4.15 for corn, $10 even for soybeans, and about $7.46 for spring wheat. Now, Iowa State University and University of Illinois recently came out with their crop budgets. So I looked back and I compared their cost per bushel versus our cost per bushel. Okay? So in Iowa, they've got budgets for 3 different productivities. They got for 188 bushel, 209 bushel, and 230 bushel corn. When you break it down, the break even with $50, right? The same $50. The break even per bushel is $4.27, $4.22, and $4.23. Interesting. So why is it that as yields go up, your cost per bushel stays the same? I mean, it's within a few pennies. And we're looking at almost a 50 bushel per acre spread in productivity. We went from 188 to 230. What's going on? This is important. This is why as a marketing guy, I like to think about, and I'm encouraging you to think about, your cost and revenue per bushel. Why is that? What happens to land rents and land values? 188 bushel, 190 bushel yield corn versus 230 bushel yield corn. You think the 230 land is going to be more expensive? And what do you guys do? You take all of your extra profit and you bid it back into rent. That's what we do. It's been going on for centuries, guys. You're not unique. So let's look at the same thing for soybeans. Iowa soybeans got 54 bushel, 60 bushel, 66 bushel. You got 3 different budgets. Break-even cost $11.38, $11.15, and about $11. So as you're in there now in soybeans, as your yields go up, your break-even goes down just a little bit, but it's within a few cents. What about Illinois? 228, 236, all the way down to 195. For break-even per bushel, corn, 461, 460, 461, and 466. You do it per bushel, it's almost identical. For soybeans in Illinois, 1101, 1105, 1125, 1156. So again, for that ground that has a little bit lower productivity, the cost per bushel does go up a little bit. So how do we compare up here with the I states, with Iowa and Illinois? If you can get that screen up again. Okay, so we're at 415. They're at about between 420 and 460 per bushel. We're at about $10, and they're at about, let me get my numbers here, they're at about $11. So per bushel, we're actually ahead of them. Isn't that interesting? Okay, so let me give you the lender's viewpoint. So I want you to think about, as a farm manager, what can I do to start managing my cost structure and try and get my cost per bushel down? The easiest way is to increase bushels. Not a surprise. Now, what happens if you don't get those bushels? What happens if you have a drought? Obviously, that's where crop insurance and other things start to kick in. You're still at risk. Part of being a farm manager is you've got to be willing to accept that risk. So now let's look at the other side of the desk. I'm going to ask you to come around and look at this stuff from the lender's perspective. And I'm almost done, I promise. So first, you guys as farm managers, the typical way you think about your revenues and costs is on a cash basis. Okay, and I'm not gonna drug you through the mud and say you know this is a bad thing. It's just sometimes it doesn't give you the information you need because the ag lenders are not looking at it from a dollars in and dollars out standpoint. They're also very concerned about what we call accrual net income. So what's the difference between accrual and cash accounting? Why is that important, especially in days like today, in an environment we're in today? Okay, so let's start with cash flow. So if I'm doing cash flow accounting, it's like your checkbook accounting, dollars in and dollars out. Okay, if I sell more and generate more revenue than the bills I write out and pay, I'm ahead. And if your checkbook balance goes up, I gotta make money, right? Not necessarily. Because on the net farm income, now we start making some adjustments. What are some of the games you play to be able to manage cash flow? We all do it. It's part of business. What are some of the things that we do? How do we fool ourselves into thinking we made more money than really did? Well, did we account for inventory changes? So many years ago, I worked with a rancher once, and he was really concerned because, man, his checkbook was getting really, really tight. I mean, he goes, I don't know where all the money went to. And so we started talking about it and said, I know exactly where your money went to. It's all those calves you bought. They're out in the feedlot right now. So instead of the money you had in the cash in the bank account, you spend them on those calves because you were trying to grow them up and sell them for more, right? Inventory changes. Rephrase that. If you started out the year with the bins completely full and you ended the year with the bins completely empty and your checkbook is full, what happened? It's a cash flow thing, right? So first and most important, did you really make inventory changes? Second, did you adjust for prepaids and deferred income? And I'm going to hit the tax issue here pretty quick here, guys, because you guys have been kicking the can down on taxes for a while. And I'm not going to let you slack on that one. I'm going to hold you account for that because IRS is going to hold you account. So again, adjust for prepaids. Last year, there was a lot of prepaids. From what I'm telling, from my listening to the ag input suppliers right now, there wasn't a lot of prepaids this year. So what happened to your cash flow? Cash went up. What happened? You make that adjustment. What did that really mean for your income? Same thing with deferred income. If you had deferred income you kicked into this year and now you're not deferring anymore, what happens? Your checkbook can lie to you. And then the final one is depreciation, not principal payments. So that's one of the adjustments. And your depreciation can be higher or lower than your principal payments. And I'm not going to get into the math of that because it's a little too complicated. So here's my point. Here's where cash flow can lead you, the cash accounting system can lead you astray. Okay, you can have positive net cash income. Your cash can go up, but you can have negative net farm income because of the inventory adjustments. You can also have a tax bill when you don't have any cash. Why? Because IRS allows you to write things off. They count income and expenses differently than the accountants do. And we're starting to run in, I'm starting to hear some mumblings that there are farmers out there that don't have the cash. They had a negative cash flow, they got a negative net income, and they still have this great big tax bill. That's hard to take. Okay, I got to pick up the pace or we're not going to get to questions. Here's one of my big pet peeves. I'm not going to go through this in gory detail. The textbook, when you guys make investments, so as we move forward in time, as we try and kind of clean up our financial house and make sure we're as efficient as possible, we start tightening the ship up a little bit. This is what the farm management textbooks say. The first thing you should ask is if I'm going to make a big investment, new combine, new tractor, I'm going to look at some irrigation equipment, I'm going to put up some new grain storage with some dryer equipment, or even buy land. The first question you ask is that the best use of my money? And we have some math things that we do to try and say, what is your rate of return on that? Is that really a good use for the money that you have available? Question number one. If yes, you move to question number two, and you say, can I cash flow that? How do I finance that purchase? If this is really a good investment, how do I finance it? How much do I put down? What do I finance? What are the financing terms? How long do I finance it? What's the repayment period? And then the last question you ask is, okay, now what are the tax implications? Okay, and it goes in that order. Now, is that the way you guys make financial investment decisions? Not the last couple of years. This is the way you did it. My farmer math. This is tax avoidance. Okay, I had a big year. I got a lot of income. Now all of a sudden I have this huge tax bill. I can't pay that in taxes. So what am I going to do? Buy some depreciable assets. Trade a combine, trade a tractor, trade a planter, put up some more grain storage, something I didn't depreciate, something I can use one Section 9 expensing on, because I got to get rid of the tax bill. So that's the goal, get rid of my tax bill. And I go to the banker and say, can I finance this? He sits down, do the math. Yep, we can make that work. Stop. Full stop. If yes, you stop the analysis. You never think about, is that really a good item to buy? Is that something that's going to have, especially in today's environment, the repayment capacity? Is it going to pay for itself over time or not? We ought sometimes, and it drives me nuts, we don't always get to that point. So here's the lender's dilemma. And literally, I've had several conversations with different banking systems over the same basic subject. This is net farm income. Notice what happened in 2023, the last column on the far right-hand side. We've got a few people that have some losses, and even those that had the yellow were barely breaking even. Now, we also have some that are doing well. So now we have 2023, and now we have 2024, where it's going to look very similar. In fact, it might look a little worse depending on how things come out. So we have 2 years in a row. We got some farmers that have 2 years in a row of losses in an accrual-based accounting system. And then we sit down and try and do the cash flows for 2025, and they're having a hard time getting 2025 to pay out. What does the bank do with that? How far do they ride with you? The lender, the banker you're working with, the lender you're working with, they want to loan you money. They want to work with you. They want to make things happen. But there's limits. They can only go so far, and that's part of what I'm trying to get at. So lenders are reviewing their loan policies very carefully for consistency. They are now they're scrutinizing agricultural loans because the ag sector is starting to have some issues. So they can loan to commercial lenders and private individuals. There's a lot of different loans, but ag loans are getting extra scrutiny. They want to maintain an income-based lending, not an asset-based lending. What does that mean? They want to loan money to people that have the repayment capacity. Not the ones that say, well, if things don't work well, we'll just refinance it because I have a lot of assets. I've got a lot of net worth. Well, net worth works great. And again, if we have this V where it drops and recovers, you'll work way back out of it. But if we have a drop with a long period of time, what happens to your asset base if you just keep rolling debt onto these assets? It's not a good situation. The banker looks bad. So we've had 2 years of negative net farm income. We're now having a cash flow problem. And the transfer payments. So let's talk about money from Uncle Sam. I had several lenders say, hey, when is this money going to come from this economic assistance payments? Can we book that and put it as income for this year so we make some of these cash flows look a little better? And they'll do that, but you got to make sure it's coming. And you got to know what the number is. We don't know what the number is yet. So lenders are willing to have what they call policy exemptions. Their loan policy. They're willing to bend the rules a little bit. The problem they have is if we do it for one, we better be willing to do it for others. So how big a problem is this? It's again, I make an exception for you just because, but well, what happens if somebody else has a similar situation? Are we willing to do this with a lot of people? What will the bank examiner say? Everybody's accountable to somebody. And trust me, the bank examiners are not, I mean, they're nice people, but they take their job very seriously. And the bank is very concerned about their own risk rating, because every year when it comes in for audit, for examination, they do a stress test on the loans. They're saying, if this were to go bad, could your bank absorb it? Well, ag loans get to be some very big loans. Okay, so what are the implications? The farm managers in the room that are currently having some cash flow issues will likely have some long discussions. If you're in that category, if you're worried about having a good relationship with your lender, please, please, please go in early. The sooner you get in there, the sooner you start talking about what the problem is and how to work with this, the better off you will be. Give the lender some time. They have other resources available, like the FSA loan guarantees. You'll still get your money. It's just, it's going to take them some extra time to get the bank some protection so they're able to ride with you. And those extra forms, that extra paperwork takes time. Now, for those of you that are in better financial condition, this can also impact you. If we have a downward trend with lower prices for a long time, for several years, this will impact your ability to grow, the rate at which you can grow. So even if you are in strong financial condition, if you're looking at large machinery purchases, these big investments, you're looking at a grain storage with dryer facilities, you're looking at a land purchase, the timing and the loan structure might be adjusted. They might require larger down payments, i.e. more of your own money. They're not going to finance as much. And you might have to look at stretching those payments out over a longer time period. Now you're saying, well, that'll help with the cash flow. But now you're paying interest longer. So the total cost of that project suddenly got more expensive because you're paying more and more interest because you're spreading those payments out over a longer time period. So with that, I know I ran a little bit longer than I wanted to. What are your questions? What are the things you want to talk about? I know there's been some probably coming in. I'm sorry I rambled a little too long on that.
No, absolutely. Let's give them a round of applause before we get into the questions here. All right, so we've got some great questions that have already come in.
Sure,
Let's start with, given the volatility of recent years in farming, what will it take for farmers to make significant changes? So we're talking about selling land, downsizing, changing some of the mix there on the farm.
So it depends. I mean, it depends upon each individual. Every farmer is a little bit different. That's one of the messages I'm trying to send. We can't lump everybody into one category. To come up with one big generic answer for everybody is going to be very, very tough. So all of the things that were listed there are possibilities, depending upon what your condition is and exactly where you want to go with your farm long term. Okay, so is this a short-term cash flow problem? Or is this something longer term? A lot of farmers now are looking at saying, well, maybe I can sell off some of those machinery assets that I haven't used for a few years. We're going to take that inventory. If it's nice to have the extra combine or the extra tractor around, but if I'm not really using it, let's sell that off and try and capture the value back. Now, there are some tax implications for that people got to be worried about. The first thing that usually happens is people start looking at different cropping mixes, saying what crops out there are profitable. I don't necessarily want to rearrange my asset base. I don't necessarily want to have a big difference in my structure of my farm. So I'm just going to look at, are there crops out there that I can grow or livestock enterprises I can get into that generate more cash? Mm-hmm. That's the first thing. Well, if there isn't anything, and usually that's the case, there's these big trade-offs, but it's very easy to flood some of these smaller market crops. The next thing they start looking at is saying, well, okay, can we restructure some of the debt? Can we take some of this debt that I'm trying to pay off really quickly and restructure that to stretch out those payments and make this cash flow a little bit easier? And again, like I said, that's very common. It's a good tool to have in your toolbox. The caution for you as a farm manager is when you add up your total interest payments over the full time, it's going to cost you more. Okay, so there's no like free lunch here. The other one that everybody wants to look for as well, let's get Uncle Sam involved and see if we can get some more checks from DC. And my only caution with that is the political environment and more importantly, the financial environment in Washington, DC has changed dramatically. Okay, and this is not a political statement on any one party. I'm not going to go there. This is not a political thing. This is about the federal budget and what is happening And obviously it's in the news right now, the federal budget, everybody wants to try and trim that down and cut it. Okay, and people are saying, well, but agriculture, we're so small. Yeah, but a little bit of things across a lot of different industries and it starts to add up. And agriculture is one of those that's on the hit list. We have to recognize that. So getting through this emergency financial assistance, I think, is going to be very difficult politically. Because if you do it for ag, everybody's going to line up and say, well, geez, you did it for ag, why can't you do it for fill in the blank? And that's going to be difficult.
You kind of answered our second question,
Okay.
but I'm going to follow up with this one, and this will probably be our last one.
Sure.
Given recent years, we've seen some shorter durations in these crisis years that haven't been quite as long as they have in the past. Do you anticipate that to continue, or do we know yet as far as them lasting longer and longer durations or shorter?
And a lot of that is driven by the markets. If you look at my graphic, you know, when you look at those time periods when we had low prices and they stayed stable for many years, it was because we had these inventories build up. It took a long time to work through this big production cycle we were in. And right now, I know everybody's looking to the international market to try and get some read on, you know, can we get rid of some of this inventory right now? You know, there's two ways you can get rid of that. Number one is you can have a crop failure next year, which nobody really wants. That'll raise prices real fast. Or the other thing is, can we have a good crop year and be able to sell this stuff internationally? And of course, that's where trade and all the trade policies have become pretty critical.
Absolutely. Always had a professor at Oklahoma State who said, we need a disaster somewhere else.
Somewhere else, that's right.
Let's give Frayne a round of applause.
Thank you, guys.
You.
Appreciate it.
Thank you so much.
Thank you.
Really appreciate it.